10 days ago, something happened that should make any rational investor with money in AI stocks completely rethink their position. NVIDIA, the company that has become the symbol of the entire artificial intelligence revolution, reported results that at first glance looked solid. Wall Street applauded briefly before the stock fell. And while analysts rushed to justify why a company valued at $3 trillion deserved even higher multiples, I was looking at something different. I was looking at the frightening parallels between what's happening now with AI and what I saw in 1999 with the internet. And those parallels tell me we're in the middle of the biggest speculative bubble since the dot-com mania. Except this time it's bigger, more dangerous, and will end even worse. Let me be absolutely clear about what's happening. Artificial intelligence is real. The technology works. It will transform industries, increase productivity, and create enormous economic value over the coming decades. But here's what people don't understand. A transformative technology doesn't automatically mean the companies building that technology today are good investments at current prices. The internet transformed the world, but most dot-com companies went bankrupt. Automobiles changed civilization, but of the hundreds of car manufacturers in the early 1900s, only a handful survived. Airplanes revolutionized travel, but airlines have been terrible investments for most of a century. Transformative technology plus insane speculation equals financial disaster. The valuations in the AI space now exceed anything I saw in the dot-com bubble. NVIDIA is trading at over $3 trillion in market capitalization, more than the entire GDP of France. Companies that add AI to their product names see their stocks jump 20, 30, 50% with no fundamental change in their businesses. AI startups with zero revenue are raising capital at billion-dollar valuation. Venture capital investors are throwing money at anything with machine learning in the pitch deck. And everywhere, people are convinced that this time is different. That AI is so transformative that normal valuations don't apply, that you have to get in now or miss out forever. I heard exactly the same rationalizations in 1999 about the internet. You see, here's what nobody wants to admit. The AI bubble isn't just as big as the dot-com bubble, it's much bigger. In 1999, the total market capitalization of all technology companies at the peak was about $5 trillion. Today, just 7 companies, the so-called Magnificent Seven led by NVIDIA, Microsoft, and Google, are worth over $15 trillion. That's 3 times bigger in absolute terms, and when you adjust for inflation and size of the economy, it's proportionally even more extreme. Capital spending on AI infrastructure is approaching $500 billion annually. Companies are spending as if AI will generate unlimited returns immediately, but actual revenue from AI products is still a fraction of the investment. Charlie Munger warned me years before he died about technology bubbles. He said the most dangerous thing in investing is when real technology meets uncontrolled speculation. The technology validates the insane valuations temporarily because it's working, which attracts more speculators, which inflates prices further until mathematics inevitably prevails. We're exactly at that stage now with AI. The technology works well enough to convince people that all the hype is justified. But when you actually do the math on revenues, profits, returns on invested capital, and sustainable competitive positions, the numbers simply don't work. And when the numbers don't work, it doesn't matter how exciting the technology is. Eventually, financial gravity reasserts itself. And when that happens in a bubble this size, the collapse will be spectacular. Let me tell you exactly how the dot-com bubble unfolded, because the similarities to today are frightening. In 1995, Netscape had its IPO, and the stock rose 180% on the first day of trading. This signaled to the market that the internet was the next big thing. Over the next 4 years, any company that added .com to its name saw its valuation multiply. Pets, Webvan, eToys, hundreds of companies that never made a profit and never would raised billions. Sophisticated investors who should have known better justified insane valuations with metrics like eyeballs, clicks, and growth potential. Traditional business models were declared obsolete. Profits were considered relics of the old economy. The really insidious part was that the technology was working. The internet was actually changing how people communicated and conducted business. This validated the hype and made skeptics look foolish. I remember being ridiculed in 1998 for saying most internet stocks were absurdly overvalued. People told me I didn't understand the new economy, that I was stuck in old world thinking, that the rules had changed. Then the NASDAQ hit 5,048 in March 2000. Within 2 years, it fell to 1,114. 78% evaporated. Trillions in wealth disappeared. Most dot-com companies went completely bankrupt. And suddenly, everyone remembered that profits really did matter after all. The AI bubble is following exactly the same script, just accelerated and amplified. OpenAI launched ChatGPT in November 2022, and within weeks it became clear that generative AI was breakthrough technology. This triggered a race where every tech company started announcing AI products, not because they'd figured out how to make money from them, but because they had to be seen as AI players or their stock prices would suffer. NVIDIA, which makes the chips that power AI systems, saw its valuation go from $300 billion in 2020 to over $3 trillion now. That's 10 times in less than 3 years. Cisco had a similar trajectory during the dot-com bubble and then fell 86% when the bubble burst. Here's what scares me about the current dynamic. Companies are spending unprecedented amounts on AI infrastructure without clear paths to revenue. Microsoft is investing over $100 billion in data centers and AI chips. Google is spending $85 billion. Amazon about $100 billion. Meta $70 billion. Combined, we're talking about over $400 billion in annual spending from just these 4 companies. To justify that spending, they'd need to generate perhaps 60 to 80 billion in incremental annual profits from AI products. But actual AI revenue across the industry is still in the low billions, not tens of billions. The gap between investment and return is growing, not shrinking. The most disturbing parallel with the dot-com era is the belief that normal rules of economics don't apply. In the dot-com bubble, people said you had to ignore profits and focus on revenue growth or even just user engagement metrics. Today, AI bulls say you can't judge AI companies by traditional PE multiples because the long-term potential is so transformative. They talk about artificial general intelligence, robotaxis, humanoid robots, and other futuristic technologies as if they're inevitable and imminent. But when you look at the actual businesses today, you see companies spending hundreds of billions, hoping that somehow, someday, the math will work. I've seen this movie before. It ends with investors painfully learning that financial physics can't be ignored indefinitely, no matter how exciting the technology narrative. Now let's talk about NVIDIA specifically, because it's become the symbol of the entire AI mania, just as Cisco was the symbol of the internet bubble. NVIDIA makes GPU chips that are essential for training and running AI models. They have about 80 to 90% market share in AI chips, and their margins are extraordinary, above 50%. The company is generating tens of billions in revenue and profits. On the surface, it looks like an incredible business. But here's the problem. The $3 trillion valuation assumes NVIDIA will maintain this dominance indefinitely, that no competitor will enter effectively. That demand for AI chips will continue growing exponentially, and that margins will remain absurdly high forever. None of these assumptions are realistic. The history of the semiconductor industry is unforgiving. Companies that dominate one generation of technology rarely maintain that dominance when technology shifts or when deep-pocketed competitors decide to compete seriously. Intel dominated CPUs for decades until it didn't, and AMD was considered dead until it wasn't. Chinese chip manufacturers are investing hundreds of billions to develop domestic capabilities, specifically because they don't want to depend on American suppliers. Google, Amazon, and Microsoft are all designing their own custom AI chips to reduce dependence on NVIDIA. When your biggest customers are also your potential competitors, your competitive position isn't as secure as it seems. NVIDIA's margins are also doomed. 50% gross margin in semiconductors is an anomaly that only exists due to temporary supply shortage and lack of viable alternatives. As more production capacity is added, as competitors launch competitive chips, and as customers gain bargaining power, these margins will compress. They'll likely fall to 25 to 35% over the next few years, which is more normal for high-performance semiconductors. This means that even if revenue keeps growing, profitability won't grow as fast. And when multiples are based on assumptions of eternal profit growth at current rates, margin compression kills valuations. There's also the uncomfortable fact that demand for AI chips may not grow forever at current rates. We're seeing a capex boom where companies are building massive AI capacity based on assumptions about future demand that may not materialize. This is exactly what happened in the telecom bubble in the late 90s. Companies spent $500 billion building fiber optic networks based on internet traffic growth forecasts that were massively overstated. When actual demand didn't materialize, the industry collapsed. Billions in equipment sat unused. Suppliers like Lucent and Nordell imploded. Cisco fell 86%. NVIDIA faces exactly the same risk. If AI spending boom slows because companies realize they're not getting adequate returns, demand for GPU chips will fall dramatically. Here's what really bothers any serious student of technology cycles. NVIDIA isn't a bet on whether AI will be important. It's a bet on whether NVIDIA specifically will capture a disproportionate share of value creation from AI indefinitely at current valuation multiples. That requires everything to go perfectly for years. No effective competition, no technology disruption, no demand slowdown, no margin compression, no execution mistake. History has taught me that companies valued for perfection rarely deliver perfection. And when they don't deliver, investors who bought at the top pay a very high price for that. Cisco in 2000 looked as invincible as NVIDIA looks now. And then within 2 years, it fell from $550 billion to $80 billion in market capitalization. That's the fate awaiting NVIDIA when this bubble inevitably bursts. Let's talk about what's happening with AI software and application companies, because this is where the bubble gets even more absurd. OpenAI, creator of ChatGPT, was valued at $157 billion in their last funding round. They're generating maybe a few billion in annual revenue, but losing billions simultaneously because the costs of running AI models are astronomical. They burned through over $5 billion in compute costs alone last year. The entire company depends on indefinite future direction, massive revenue growth, and somehow figuring out how to make the business profitable, despite the unfavorable economics of large language models. This is the textbook definition of an overvalued technology company built on promises, not profit. But OpenAI at least has a product people use. Look at the broader ecosystem, and it gets even more bizarre. AI companies with zero revenue are raising Series A rounds at $500 million valuation. Startups that just wrap OpenAI's APIs with a user interface are being valued at hundreds of millions. Venture capital investors are so desperate to have AI exposure, they're throwing money at companies without viable business models. And public companies have discovered that simply announcing AI features, even if they don't contribute meaningful revenue, can add billions to market capitalization. It's pure speculative mania, indistinguishable from companies adding .com to their names in 1999. The fundamental economics of many AI applications simply don't work at current prices. Running an AI-powered chatbot costs significantly more than traditional customer service methods. Generating images or videos with AI consumes massive computation, making costs exceed what most users will pay. OpenAI charges $20 per month for ChatGPT Plus, but likely loses money on many users due to compute costs. Companies are subsidizing users hoping that somehow scale will solve the economics. But semiconductors and electricity don't follow Moore's law the same way software does. Costs may fall, but not fast enough to make many AI applications profitable at prices consumers will pay. There's also the question of competitive moats in AI, which in most cases don't exist at all. During the .com bubble, people believed in network effects and first mover advantage. It turned out that for most internet companies, customer switching was easy and competitors could replicate features quickly. AI is even worse in this respect. The underlying models like GPT, Claude, and Gemini are becoming commoditized. Open source companies like Meta are giving models away for free. Any developer can build applications on top of these models. There's no real customer lock in because switching between AI providers is trivial. Companies that think they have sustainable advantages in AI will discover they're in brutally competitive, low-margin markets faster than they imagine. Here's what makes me particularly worried about the AI application layer. Unlike infrastructure, where at least NVIDIA is selling real hardware generating real profit, most AI software companies are burning money chasing growth without clear path to profitability. They're pricing products below cost to gain market share, betting they can eventually raise prices or reduce costs. But in competitive markets with low barriers to entry, pricing power rarely materializes. History is filled with companies that grew fast burning investor money, only to discover they could never build a sustainable business. WeWork, Uber before profitability, countless food delivery companies. AI will follow the same pattern. Rapid growth funded by venture capital, followed by brutal realization that unit economics never work. Now let me address the argument I constantly hear from AI bulls. They say AI is fundamentally different from the internet because it's more transformative, faster to implement, and has broader applications. They point to productivity gains, automation of white-collar jobs, and eventually artificial general intelligence as justifications for any valuation. But here's what these arguments completely miss. Even if all this is true, and AI is as transformative as they say, it doesn't mean current companies at current prices are good investments. There's a huge difference between a technology being important and a specific stock being well valued. The automotive industry completely transformed civilization. It changed where people lived, how they worked, the entire structure of society. But if you invested in automobile manufacturers in the early 1900s, you probably lost all your money because most of them went bankrupt. There were literally hundreds of car companies. Only a handful survived, and even the survivors like Ford and GM were mediocre investments for most of their history due to brutal competition, capital intensity, and thin margins. The fact that cars were transformative didn't make car stocks good investments. The same principle applies to AI. Transformative doesn't equal profitable. Bulls also point to speed of adoption. ChatGPT reached 100 million users faster than any previous product. Companies are implementing AI tools at record speed. But rapid adoption doesn't equal sustainable monetization. Facebook reached 1 billion users long before figuring out how to make serious money from mobile. Twitter had hundreds of millions of users, but struggled to become profitable for years. YouTube was hugely popular, but barely profitable for nearly a decade. Users and usage don't pay the bills. Revenue minus cost pays the bills. And right now, most AI products have huge usage, but terrible economics because they're expensive to run and difficult to monetize properly. There's also this notion that AI will lead to such massive productivity gains that companies can justify spending any amount on AI infrastructure. But productivity gains take time to materialize and are often overstated. Remember the productivity paradox of the 80s and 90s when we spent trillions on computers, but productivity statistics barely moved for years. Eventually, productivity improved, but it took decades, not years. Even if AI doubles knowledge worker productivity, and that's a big if, it will take years for that to translate into enough corporate profits to justify the $400 billion in annual spending happening. Companies spending aggressively today based on hypothetical productivity benefits tomorrow will learn painful lessons about returns on invested capital. Here's the fundamental reality AI bulls refuse to accept. Transformative technologies follow a predictable pattern. First comes hype, where everyone overestimates short-term impact. Massive investment flows based on promises. Valuations explode. Then comes disillusionment when reality doesn't match hype. Investments are wasted. Companies fail, valuations collapse. Finally, Over decades, the technology really does transform the economy. But it's usually a different set of companies that capture the value, not the early pioneers who burned out at insane valuations. This is exactly what happened with automobiles, aviation, personal computers, and will happen with AI. The technology will be transformative, but that doesn't make today's stocks at today's prices good investments. In fact, it usually makes them terrible investments because you're paying fantasy prices for uncertain reality. So here we are, and I want you to understand exactly what I'm saying about the AI bubble. I'm not saying artificial intelligence is a fraud or that the technology doesn't work. It does, and it will be transformative. What I'm saying is that we're in the middle of the biggest speculative bubble since the dot-com mania, and possibly the biggest bubble in modern history when you look at the absolute size of valuations and the scale of wasted investment. The companies dominating the AI narrative today, trading at multiples that assume perpetual dominance and eternal growth, will face a brutal reckoning when reality inevitably intrudes. And that reckoning will destroy trillions in paper wealth. The math is relentlessly clear when you remove hype and emotion. Companies are spending $400 billion annually on AI infrastructure to justify that spending at a modest 15% return. They'd need to generate $60 billion in incremental annual profits from AI products, not revenue profits. Right now, actual AI revenue across the industry is a fraction of that. And profitability is often negative because running AI models is expensive. The gap between investment and return isn't closing, it's widening. And when the gap gets too large, investors eventually stop funding losses and demand real returns. That's when bubbles burst. NVIDIA at $3 trillion, OpenAI at $157 billion with massive loss. AI startups with zero revenue at hundreds of millions in valuation, public companies adding billions to market cap just by announcing AI features that don't generate revenue. These are all classic symptoms of speculative mania. And what makes this bubble particularly dangerous is that it's much bigger than dot-com in absolute terms and is concentrated in fewer stocks. When the Magnificent Seven, which represents 30% of the S&P 500, is all exposed to this AI narrative, a correction in this sector won't be isolated. It will drag the entire market down with it. My advice is simple and straightforward. If you own AI stocks at current prices, especially companies trading at extreme multiples based on future promises instead of current profits, you're not investing. You're speculating. And when you speculate in bubbles, timing is everything. You can be right about the long-term direction of technology and still lose all your money because you bought at the top of a mania. Cisco was a great company with real technology and real customers in 2000. It still fell 86% because it was valued for perfection that wasn't delivered. NVIDIA, OpenAI, and dozens of other AI companies face exactly the same fate. I've spent 70 years studying markets and bubbles. I saw the Nifty 50 mania of the 70s. I saw the dot-com bubble. I saw the housing bubble. And each time, most investors convince themselves that this time is different, that old rules don't apply, that you have to get in before you miss out. Then the bubble bursts, trillions evaporate, and everyone suddenly remembers that valuations matter, that profits matter, that you can't ignore financial physics indefinitely. The AI bubble isn't different, except it's bigger. And when it bursts, and it will burst, the losses will be spectacular. You don't need to be there when it happens. You can exit now, preserve capital, and wait patiently for rational prices to return. That's what disciplined investors do. They don't chase bubbles, they avoid them. And if you ignore this warning and buy or hold AI stocks at current valuation, don't say nobody warned you when prices eventually return to earth with a painful and expensive crash.